So let's talk about the earnings season that has gone by, the indicators from that, and what it means for the markets. Vinod Karki, Head of Strategy at ICICI Securities, now joining in with that. Good morning, Vinod. Thanks for joining in live. So let's talk about the earnings season that's behind us. First up, opening comments on the season that's gone by, a season where, you had to see companies figure out margins. It's a season where they've had to deal with high inflation as well.
Yeah, good morning, and thanks for inviting me to the show. So if you look at the earnings, there are two, three things one should be focusing on. One is what has happened and what are the leading indicators telling you about what things are going to, how they're going to pan out. So in this quarter that had gone by, if you look at high frequency indicators which talked about demand, like say PMI numbers, manufacturing services, or the GST, exports and things like that, and the credit growth also was clearly indicating that the demand was pretty robust. What was also very clear that commodity prices were spiking, and more so after the Ukraine-Russia conflict. But at the same time, during the quarter, we started observing that the commodities have also started peaking out and started coming down. So if you look at the results, it's showing similar patterns. If you look at the top line, it's a very robust top line. Not just because there was a base effect, which we know clearly there was a base effect, but if you take out that base effect, if you look at volume growth of infrastructure companies, building material and other companies, discretionary consumption, even the consumer staples and all, the volume did not, the top line, if you make out volume plus top line, both did not disappoint. So which indicated that the demand is not bad overall. While we knew that the inflation will take out the profits, the profits will not be that strong. And which showed up, so there was an impact on EBITDA margins, profit and all. But overall, if you look at the what was expected and what came out, it was not a disappointment even on the profit number. While on the sales and the top line, it was a surprise on upside. Now, if you look at how things will pan out, the first trickle of high frequency indicators that you're getting from Q2, the current quarter, is again very robust. If you see the PMI numbers and the GST collections and again credit growth,
right?
So that's showing good. But the bigger thing is that inflation.
Even if you see. In fact, even if you were to see the tax collection, the data that's been put out by the Income Tax Authority itself, a 34% rise in the first quarter year on year. But, I'd like to be sector specific with you as well, because that's what will really help our viewers. Now, if you look at the earnings season that's behind us, it's the banks that contributed 26% to incremental profit after tax. It's a conversation we've been having here on ET Now. So seeing this indicator also from the first quarter and going forward, do you expect banks to have the leadership position, banks to end the year at numero uno?
Yeah. So banks and financial. So if you see this quarter, in fact, the bank's profit was held back by treasury gains not being there. In fact, some banks showed, because the bond yields rose in this quarter, right? There was a spike in bond yields. But if you see right now, the way commodities and oil prices are falling, in fact, the reverse will happen in the next quarter or so, where bond yields will be which will be lower, and you might not get that the pressure from treasury losses that we saw in this quarter. While on the core demand perspective and margin perspective, since the rates have been increased, and we know there is always the lead lag there, I think they are set up pretty well. Banks to see maybe earning surprise going forward, and we know that the NPA cycle we are at the bottom and just finished. We are just there is no NPA issue as such in the system, so which is a major concern. When you look at banks and their cycles, so that concern is not there. while the credit cycle is just about to take off, and we are seeing that in the industry credit also. And some of the concerns around bond yields spiking significantly, hurting them on the treasury side, that is also abating. So I think they're on a sweet spot over there. And if apart from these banks and financials, if you look at what the micros, I mean, the company results are hinting towards macros, is very clear. We are seeing demand from the credit side of the companies, then from the investment side. So if you look at all the large capital goods infra companies, they have shown pretty good, robust order book, and the growth is good. So if commodities fall, they'll have better margins. So I think that space, the investment cycle and the building material and other companies related to the investment cycle, I think their outlook is looking good, and falling commodities will help their margins. And the third, but not the least, is the whole discretionary consumption, which after the COVID impact is opening up pretty fast. Right. And we are seeing good, so these three pockets, I think, I will do well.
So that's what the earnings season that's gone by is looking like. Maybe we'll start to see downgrades for energy, commodity staples, just the way prices have started to come down. Banks looking like they'll stay in the sweet spot that they are in. Vinod Karki, thanks so much for joining us live today, analyzing the first quarter earnings scorecard for us. The earnings season officially behind us. Well, with that, I'm going to hand it over now to Nikunja